Steve Nicholson, Senior Grains and Oilseeds Analyst with Rabobank Finance in St. Louis. So this year, I've changed things up a little bit, but there's a lot of things happening within agriculture and within the economy that I think we need to talk about and kind of discuss here, because it has an impact on your business and will continue to have an impact on your business way beyond even 2022. So let me go through some headlines, and these are both good and bad, or challenges and opportunities that we have and we should be able to take advantage of. So, when we think about crops here in 21, the crop we just harvested, we solved the supply issue. We have better supplies, things look better. But however, on the other side of that, the demand side continues to be very robust, and that is good for all of our businesses, all the way up and down the food chain. But one of the things here in the States is, even though demand is robust and we've sort of fixed that supply issue, we need more acres. And the bottom line is, when you look at the North American market, whether it's Canada, whether it's North America, even most places in the world other than Brazil, we have an acreage constraint. And so technology is going to be very important to increase production, primarily through yields. One of the big issues that we're facing and that we have to be thinking about is geopolitical issues or dynamics around the world. Think about Russia and Ukraine. Think about China and US-China relationships and all the challenges there. Think about even Eastern Europe and Russia and its relationship also with NATO or the EU. The Mideast will always be a problem. And when you look at all those geopolitical issues, they've changed. It's not just about war. It's about cybersecurity war now. And you might think about that and think, well, that's not really a big deal in agriculture. The bottom line, it is. Think about what's happened in the US of recently. Colonial Pipeline in the eastern part of the United States. You had the new cooperative in Iowa was hacked and didn't have their systems in place, which meant when you delivered grains to them, it had to be all done by paper. You had JBS, the big meat company, same issue, was hacked. So these are issues that we have to be thinking about, and think about what happens if not only your suppliers or your customers are hacked. What about your machinery? Think about machinery is all on the web now. And what if that system gets hacked and you're stuck? These are all things we have to think about. We know about the exploding input costs and supply constraints around that. Think about the government. The government has put so much money in because of COVID, and it's backed away from that now. It's not going to be there anymore. And we're going to give new farm bill. We'll start debate here in 22 as well. We could spend a whole hour or two just on sustainability, carbon farming, carbon emissions, carbon sequestration, greenhouse gases. Those issues are going to be coming down the pike, continue to come down the pike at you, and will affect your business, how you run your business, how you manage your business, and how you plant and harvest your crops. We've talked about rising costs. Fuel costs are obviously one of those. One of the big areas we have not talked about in the past years is low carbon fuel standards. It does kind of go in that whole sustainability basket, but the fact is this is a whole nother animal, because renewable diesel plants are coming, they're on the books, they're under construction, and the demand for feedstock, which is vegetables and fats, is going to outstrip the ability for us to supply that market. So something to be watching for, and opportunities if you have oilseed processing around you, maybe a new opportunity for you. And finally, just in that same vein, basically over the next 4 years, almost $5 billion investment in oilseed crushing in North America. So again, an opportunity for you. And oh, by the way, COVID's still with us and we have to deal with that. So that's just kind of a big picture, all the different issues. A year ago when we looked at this, we didn't have all these, and now all these things are in front of us. So let's start to dive into the economics of what's going on. So if you look at global economic growth, it's kind of been the black and white or a yin and yang sort of picture. Obviously, COVID really took it down. We saw a nice rebound, and we've seen economies come back very strong, which is the good news. But when you look down the road, and even I'll show you some pictures here, or show you a chart in the US, we start to see GDP start to go back into its typical pattern of fairly slow, fairly methodical growth. That's good news and bad news, but the stimulus that we saw is fading away, and so is economic growth. And that's important for us from a food perspective in demand from the consumer. If we look at US growth, you can see the same thing that we saw in the global growth. We saw the big drop because of COVID, we saw the big upsurge because of all the physical stimulus, and now just here in this third quarter of 2021, when we looked at that, it's only a 2.1% growth. So it's back to a pretty pedestrian growth pattern. Now, part of that growth has been, as I said, was fueled by fiscal stimulus from governments and central banks, low interest rates, the quantitative easing of the Fed, and also all the stimulus we saw from the government from the 3 different COVID programs. And we've seen that in the disposable personal income. The person or the individual has had all this income to spend. They've been pent up demand because they've been at home, and when they could get out, they were willing to spend that money because they had it to spend. And now we've seen that disposable income start to come back now, and that's going to be a bit of a negative on food demand, or or the other way around. Food demand will be a little bit lax from what it was. But the fact is that this is the classic definition of inflation, of more money chasing fewer goods, or more supply of money or income chasing fewer goods. And that's what we're experiencing right now, and that's what we're seeing in inflation. And when we talk about inflation, this is not transitory in our view. This is going to be with us for a while. Granted, as we get over a year, maybe a year and a half, we'll start to see the inflation wane because it's comparing versus the previous year. But the fact is, those prices are set in, and we're going to continue to see those. And I think one thing that's really interesting in this particular state is that when you look at core inflation, which is less food and energy, it's running at 5% as well. The last inflation number we got before we did this video was about 6.2% on an annual basis. So you can see that even core inflation is hot when you take energy and food out. So that's a really important point to think about. This is not all being driven by food and energy. It's been driven by the whole economy. And when you look at the other thing that's more troubling about the inflation and why one of the reasons we don't think it's transitory is that when you look at the CPI, Consumer Price Index, which is the reported, versus the PPI, the producer price, it's about wholesale prices. Now the PPI is much more volatile, and we expect that because of what it does, but the fact is it's also a precursor of what is going to happen to consumer prices. The PPI now is at a level we have not seen for a very long time. It's above 20% in the last recorded numbers. And so that tells me that we're going to see more inflation down the road than we've seen in a long time. So keep that in mind, and keep that when you think about your capital spending and think about your business planning for the business. Now, if we talk about interest rates, there's always what are interest rates going to do? Now, for those of us who are old enough to remember Chairman Volcker and the last big run-up in inflation, and what did interest rates do? They went up. This Fed's been a lot more cautious about saying that. And when you look at the famous dot plot the Federal Open Market Committee puts out, and we're looking at the September one here, the December one won't be out for here a couple, 3 days after we videotape this, but you're still only seeing a little bit above, kind of a 3.5% type number when we get longer term. But I wonder, as we see the Fed starting to talk about, and the markets are also factoring in 2 to 4 increases in interest rates in 2022. Now, we're not talking huge rate increases, but we're still talking an increase of basically 0 to upwards of 2 to 3%, and maybe even 3.5% before it's all said and done. So you can see that's coming likely sooner than later. Now let's start to look at agriculture and look at kind of the big picture in agriculture. One of the reasons, and we talked about robust demand for commodities and foodstuffs, part of the reason that we're seeing also these prices being well supported is because of the decrease in stocks of the major grains, corn, wheat, and soybeans. We do see a few increases in corn this year, and in 21-22, we see corn stocks going up a little bit. We also see soybean stocks going up a little bit. But when you look at that over the course of history, and as you see this on the chart, we continue to see relatively historic lows, not pipeline, but relatively, when we look over the past 20 years, relatively small stocks. That will be a very good indicator of what prices are going to do. And if you take that one step further and look at stocks to use ratio, it tells you an even more bullish story. You see stocks to use ratio for the 3 major commodities all at very low levels, which tells you the demand is robust and the supply is not able to keep up with the demand. And if you look at wheat, it has been down now for 4 consecutive years and likely to go down again. So something to keep in mind is that both the stocks level and the stocks to use ratio are at low levels and will be very supportive to commodity prices as we go forward. The global situation, while not as tight, has the same sort of tenor. You see about 4 to 5 years of declining stocks from very high levels. We need to concede that. But when you also look at that stocks to use ratio, it is also coming down, and it's not finding a level place yet. It's not going down as much as we project into 21-22, but the fact is it is coming down, again, telling you that demand is robust and not big enough for the supply. One of the topics that's been a big topic within commodity markets has been exports to the U.S. are horrible. They're just disappointing. That's why we see the bearish story on commodity prices. I want to step back a little bit of that, and let's put that in perspective. If we look at commodity exports, U.S. corn, wheat, and soybeans, and you looked at just 21-22 in isolation with no other perspective, you would look at it and go, boy, this is a pretty good year. Wheat maybe being the disappointment there. But when you look at it over the last 20 years, it still looks good, except for last year. 2021 was such an exceptional year that everyone's measuring against that and thinking, boy, exports are terrible. Well, I think we have to put that in perspective. Exports are still good, and that will still continue to be a driver of U.S. commodity prices as we go forward. Now, we talked about this in the headlines, and one of those is acreage constraints. And when we look at acreage constraints, what we're saying is that there's very little ability for the U.S. to, in a sense, build out more planted acres. And you look at, and we show you here in the chart, the 10-year baseline. And so we look at corn acres are going to be around 90 million acres. We look at soybean acres are going to come up nearly with par with soybeans over the next couple of years, partly because the demand for oilseeds and also the demand for vegetable oils for renewable diesel is going to enhance or buy more soybean acres. But then soybean acres will start to fall off in the last 5 years of that. We look at wheat acres, they're going to peak around a little over 47 million acres, and then start to fall off, but very gradually because there's a big demand, the demand for wheat and the concern about weather around the world and about whether we will continue to see wheat production that will fulfill those needs overall. As I talked about up front, when we look at U.S. principal crop acres, it's a long-term downtrend. For those of you who are wheat growers, you know what that means in wheat. We've seen a long downtrend of wheat acres across the United States, and we're seeing the same thing in principal crop acres. We're now around 315 to 320 million. Just a short 10 years ago, we were more like 325 to 330 million. So you can see those acres are dwindling and we're constrained. And that is true for almost every place in the world other than Brazil. Brazil continues to climb. I think the concern with Brazil is they are taking, and not necessarily deforestation, but they're taking permapasture. And at some point, there'll probably be some pushback in Brazil about we need sustainable soybeans or we need sustainable corn, that this was not crop grown on rainforest or on permapasture. These are sustainable crops long term. And if we look just quickly at potato acres, you see the same trend there. Potato acres continue to decline, and we see that across even the major states. Their share of the total acres is declining as well. So it's not just in what we may call the marginal potato acre states, but it's among all the potato states and even in the major states. So that's following that national trend. I do want to show you 2 quick slides on the renewable diesel. This has potential to be transformational to the oilseed complex. By 2024 and then by 2030, we expect that there'll be 35 billion, and by 2030, 40 billion gallons of renewable diesel being built. If all the plants that are either producing now, under construction, or proposed happen. And when you look at that from a vegetable oil requirement, that means that we need nearly 7 billion pounds of vegetable oil or fats in the marketplace. And that's just not going to be possible. We just don't have that. If we look at this a little closer and we kind of focus in on the US, and you see by the time we get to the late 20s and 2030, the US is going to have a deficit of nearly 40 billion pounds of vegetable oil. Just for perspective, we only produce 24 to 25 billion pounds of soybean oil in the United States on any given year. So you can see we need to really ramp up production and figure out how this is going to work. I will tell you, as I said, that's transformational to the whole industry because we need the acres, we need the production to produce, and the crushing capacity, which we are increasing, but won't be enough to meet this demand. So there's a reckoning yet there to come. So from a rotational standpoint in your potato operations and in potential other crops that could be profitable to you, oilseeds are one play to look at, particularly soybeans and canola here in North America. Okay, we're going to change gears now, and we're going to talk about wheat, corn, and soybeans and what's happening in those markets because those markets impact you on your rotations, obviously. So let's start with wheat because that's really the most important crop to us as potato folks. Wheat's a really interesting. I've had a lot of questions about how long do you think the wheat prices will be good and so on and so forth. I'm fairly optimistic. I think assuming we have good wheat crops in the Northern Hemisphere this summer, I think wheat wheat prices will stay pretty good until we get some indication as this crop comes out of dormancy that we have a good crop this year. But having said that, we still have areas of the country, when we think of everything kind of west of the Missouri River, and in Canada, it is still very, very, very dry. And in Canada, and even here in the middle part of the country, we've had a fairly dry fall. We have not had a lot of moisture. It doesn't show up as a drought, but it does show up as being dry. And so I think I don't know that we can say the wheat's going to be high forever, but I think at the same time, we have to recognize that wheat has the potential to stay here because we're very, very tight on wheat. The other thing, when you look at winter wheat conditions, and this is the other thing that's concerning, is that, we looked at these last year and thought, they were down, and we thought, boy, they couldn't get much worse than that. And reality is, when you look at the fall winter wheat conditions, they are worse than they were a year ago. They're not as bad as 2013, but they are worse than a year ago. Now, we know what happened last year. We got timely rains and the wheat crop produced gangbusters, and that could very well happen. But we're not coming into spring, when we come out of dormancy, with a crop that's in really good condition. And as I said, we have to watch it to see how it comes out. But the fact is, there are some challenges ahead for the wheat crop that will be supportive to wheat. The one thing I will caution, though, is the trade, and this goes for all of the crops. We went into the spring dry. We stayed dry pretty much all summer. We got a little spoon fed of wheat, and the trade's going to go, last year you said it was dry, and look what the crop you produced. We're not going to bid the price up at this point. But at the same time, we have lower stocks than we had a year ago. The trade's going to have to come to grips with that and understand that just because we had a good crop last year and it didn't rain doesn't necessarily mean we'll have a second year of that going forward. So something to keep in mind and be paying attention to. But as we say always on marketing, understand your margins and market to those margins. One of the other things in the wheat market that's really interesting is protein premiums. Now I'm looking at 12% Kansas City protein premiums. They're at record values. They're almost $2.70 a bushel, which is unbelievable. So those of you who can produce high protein wheat or have high protein wheat in the bins, the market is telling you, I want it now and I'm willing to pay you for it. So that is a reoccurring theme year after year, is to getting enough protein for this market. And part of the reason for the high protein premiums this year is because we don't have any hard red spring wheat, and we're very, very low on that. And if the fact that it's still dry in the northern plains and in Canada, where most of the HRS is planted, tells you that protein, and you have high protein, that could be valuable for another year. When we look at by class and look at total wheat stocks in the United States, it's the 5th year of consecutive decline in stocks. We have to go back to 2013-14 to look at stocks that low. So that's the thing, and we see that all wheat price respond to that, and so we expect that will continue to be the case as we go into 21-22 and likely into the 22-23 crop year as well. We look at world wheat stocks. They are very high, but they are off their peak. This is the 2nd year of declining stocks, and like with everything else we talked about, the stocks to use ratio is declining as well, and declining very steeply. So if we do get good crops this year, then everything we just talked about will be moot. But the fact is, we need good crops to keep things getting very, very tight and very, very expensive for all people. So the wheat market is in a good position. Understand your margins, a good opportunity to market some wheat here going forward. When we look at planted wheat acres, we do expect them, as I said, to peak out about 47, but we believe for the most part they're going to be under 47 million acres when we look at our 10-year baseline. On the other hand, as those acres come down, we do expect that wheat prices will be this is farm gate wheat prices, national average received, will be 75% probability they'll be $6 or below. But for the most part, during our 10-year baseline, they stay between $5.50 and $6. So wheat, as we say, wheat prices do look good as we go forward. So let's go to the corn market and talk about that real quickly. So what you're seeing here is a real quick dashboard of stocks and price and stocks to use of price, and also the change in stocks versus price. And you can see from a corn perspective that, we're going to see a little better stocks this year, but the fact is the price is still pretty good because that stocks to use ratio is pretty low. And so the market is trying to attract acres and is trying to attract corn into the marketplace. But, as I said earlier, the corn exports have been a little bit lagging this year. Inspections are down 17% from a year ago. Outstanding corn sales, though, are running only 4.6 behind last year. So let's keep that in perspective. This is compared to last year, which was a record year. Ethanol market has rebounded. That is the good news for the corn market and is going well. Stocks are expected to increase, like I said, but the fact is because the demand's so good, we'll see that going ahead. But again, the challenge on the corn market, like all of our markets, is this increase in input costs. Again, understand your margins, understand your input costs, and market accordingly. If this market at 5 to 5.75 on the board gives you good margins, then you need to take it and go with that and lock that margin and go forward. You can't lose a business if you make a profit. So if we look at outstanding sales, yes, they are lagging behind last year, but the fact is they're just lagging behind last year, about 9%. But the fact is they're on a really nice track for all the previous years. They're better than the previous years. So good outstanding export sales on corn. Ethanol is terrific. We're running about 4.2% versus the 5-year average. And if you look at current, we're running about 8% above what we would normally versus a year ago. So ethanol production is good, and that could be a whole discussion of the future of that. But the fact is, this is where we can make hay. I will say one thing about ethanol. ADM has partnered as a memorandum of understanding with a company that has technology for sustainable aviation fuel. Could be a very important component for the ethanol market in the future. And so when we look at our 10-year baseline on corn, we're looking 75% probability on acres will be 92 million acres or less. But when you look at our baseline, we're kind of in that 90 to 92 million acre period going forward. And you look at prices, a lot of volatility in corn prices. 75% probably there'll be 5.25 or below going forward. So we'll finish up with soybeans. And as I said earlier, oilseeds is where there's some opportunities. You're seeing a dashboard here of stocks to use versus price. You've seen similar stocks price versus price. And then you've seen stocks, change in stocks versus price. While you see a small increase in stocks this year, the fact is we are going to see very good prices for soybeans going forward because the demand for oil in particular is very, very strong. And the other thing that will happen over the next 3 years is all this crush capacity coming on. If you look at the trend line for crush versus this new capacity by 2024, it's a 15% increase in crush. That will be very supportive to prices and very supportive to increased acres of soybeans here in the United States. We must say a little bit about Brazil at this point. Brazil got off to a great start this year, had good moisture, good planting, got the soybean crop in early. That's the good news. Here in the last several weeks, it has started to turn dry, and it has started, and also in southern Brazil and also in Argentina. So going forward, we don't know how this is all going to end up, but it is a La Nina year, and so we tend to see dryness across South America and the southern Brazil, Argentina. We see dryness across the southern plains and the southeast United States. So something to keep in mind, and that weather will continue to be a very supportive factor in these markets going forward. Just quickly, soybean exports got off to a very slow part, and they're lagging last year by 22%. But the fact is, they quickly came up and got back up to actually the levels that we saw in October, November of last year. It's just we got off to a slow start because of Hurricane Ida. We saw the port of New Orleans really kind of gimping along, if you have it, for the first 4 weeks of the crop year because of the hurricane. But when you look at outstanding sales, they're much more normal. They're not what we saw last year, but the fact is we still have good sales when you look at back over time. You look at our 10-year outlook, just to kind of finish up, we do see planted acres of soybeans, 75% probability there will be 90 million acres or less. And at the same time, when we look at that price level of soybeans, we expect them, this is the national average farmer receipt price, will be 75% probably they'll be $12.50 or below. So again, good prices going forward. And so we expect to see, a pretty good year when we look at 22 overall, but there'll be some challenges as we've spoken out, but opportunities there, particularly for those of you who are looking for new opportunities in the oilseed market. So thank you very much for your attention. I look forward to seeing you in Anaheim this year, and thank you very much.